The original air date of this show is March the 29th, which means that it is, in fact, crunch time for many taxpayers. And so we wanted to talk about a little bit of emerging trend that is, in fact, costing taxpayers quite a bit more money than what it has in the past. And these are some things that can quietly make your tax bill a whole lot more. So when you do your taxes, you've got, obviously, okay, here's how much I owe in taxes, and that's the amount. But then what you can see happen is both interest and penalties can then layer on top of the amount that you owe when you owe money if you're filing taxes. And this is becoming more and more of an issue because in the past, when interest rates are low, then it was kind of negligible because the interest that the IRS charges is based on current prevailing rates. Well, rates have obviously come up quite a bit over the past 2 or 3 years. And at the end of the day, that cost has also increased accordingly. And what some of the stats are showing is that higher income taxpayers, right, because usually higher income taxpayers are going to have a larger tax bill, are creating more and more of a burden for individuals because those IRS rules around sort of paying throughout the year are less forgiving than you think. The concept is that you pay your taxes along the way during the course of the year, and then if you owe a bunch, then you didn't pay enough along the way, and so there is a charge to that in the form of a penalty. And so the numbers are starting to kind of get noticeably bigger. This is the most recent data point. Penalties for filers. So these are penalties for filers earning between $200,000 and $500,000 who failed to make timely estimated tax payments. Surged to nearly $1.3 billion combined in the year 2024, about triple the amount from 2021, again reflecting that increase in interest rates between 2021 and 2024. And the number of affected filers increased by about 30% to nearly 3 million people. So what's going on? Two different concepts to understand here, folks. First, interest. If you have an outstanding tax balance with the IRS, they will charge you interest. They're not giving out an interest-free loan while they wait to collect your tax money. They are charging you interest if you owe them money, not unlike a bank. The second sort of piece is penalties. Common penalty that the IRS is going to charge is an underpayment of estimated tax payments. Basically, you didn't pay enough along the way, you didn't do enough with your withholding on your paycheck, or you didn't pay the estimated payments along the way. And the impact, of course, is very real when we talk about the penalty itself increasing cumulatively to over $1.3 billion for taxpayers. That's a pretty significant amount of money. And, even if you can't afford to pay the tax, if you're paying it late or unevenly, it can often generate some extra cost. And where that's particularly true and who that particularly impacts is people with sort of variable income. So if you get bonuses, if you get commissions, if you've got self-employment income or big capital gains, that's where you can really start to have a much more significant impact on the amount of what that penalty is going to be. So what are some of the things that you can do to avoid this, right? Because probably, if you owe a bunch of taxes, you probably don't want to pay extra money because you owe taxes. You'd like to minimize those interest and penalty costs. And so we've got some things that you need to do now to really set yourself up so you're not getting tripped up by this issue. And the first involves actually looking at your completed tax return. Far too often, people complete their returns and they pay what they owe, and they don't really look at what the components are that they owe. Is it really a tax bill, or is there some portion interest? Is there some portion penalty? And far too often, we drop it in a file cabinet, or in today's world, you throw it up on the cloud next to all those thousands of pictures of the kids that you're never going to actually develop, and never to be retrieved or looked at again. That's not good, because what you want to do is you want to take that completed tax return and see if that is happening. And if it's happening, then you need to do things like adjusting your paycheck withholding on your W-2. And that means that you lower your number of exemptions, don't increase them. Lowering them increases the tax withholding. Or maybe you wind up having to commit to pay some quarterly tax payments along the way in order to avoid that. So the first key piece to try and avoid this extra cost is actually look at your tax return and see whether you're paying it or not. And then second of all, if you have sort of non-wage income, so it's easy to increase your tax withholding on your W-2, but if you've got a bunch of capital gains, or you've got other type of like self-employment income, then you've got to make a plan to pay estimated tax payments. The key idea here is that you're paying a certain amount along the way to avoid any kind of underpayment penalty. Key concept there is the safe harbor level of payments, which is tied to be 110% of last year's tax liability. So if you've got that sort of non-wage income, capital gains, self-employment, whatever the case may be, then you probably are going to want to set up some type of a quarterly payment system so that you're paying in along the way as you should be in order to avoid the taxes and penalty. The third, and this is kind of sometimes a surprise, all of your taxes, regardless, are due April the 15th. It doesn't matter whether you file an extension or not. If you file an extension, make sure that you have paid in enough to cover your tax bill, because if you go past the April 15th date and you still owe money, then there's a pretty significant penalty that applies based on the amount of money that you owe. So if you can't file your return on time, that's okay. That's, they do give extensions, but you got to make sure that you pay all of the money that you owe. Otherwise, these interest and penalties are going to come into play. And then lastly, make sure you're kind of building taxes into your cash flow routine. This is a particularly important one for folks that are retired, and maybe you're collecting money out of an IRA, or you're getting an RMD, collecting Social Security, maybe you've got some dividends, some capital gains. All of that then has to be understood in terms of what its total tax liability is, and to make sure that you are withholding the right amount of taxes. Now, some things you can't really withhold taxes on that easily, or really at all. Things like dividends, things like capital gains, things like 1099 income, things like investment income, all of that, you're going to have to kind of do a comparative quarterly estimates in order to cover the tax liability on that. So the reality is this: we're in a much higher interest rate environment, so the IRS interest that gets charged is much more noticeable, and underpaying during the course of the year can certainly trigger some significant penalties. So make sure you're taking the time to really work out a strategy to help avoid this additional cost when it comes to your taxes. With that, we're going to take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning, continuing after these messages.